Today we're covering premium discount of ranges and also buy side and sell side liquidity, so pools of liquidity, and this is going to help further your understanding of why price is moving between certain levels. In the previous episode, if you haven't already watched it, I highly suggest you do. We covered parent and subordinate price swings. I'll put a comment card in the top right hand corner, so if you haven't watched that already, I highly suggest you do. But this episode we're covering premium to discount of dealing ranges and liquidity pools. So what I mean by that, what we need to know is that every swing has a clearly defined range between premium and discount. If we take this range, which is this low to this high on the hourly, we have a range formed, and within inside that we have 50%, which is considered fair value. Anything below 50% is considered a discount, and anything above that is considered a premium. Okay, and price moves between a discount and a premium when in a bullish profile, and in a bearish profile it moves from a premium to a discount. So price is either moving from a premium to a discount or a discount to a premium. And as with subordinate and parent price swings, we have parent and subordinate premium and discount dealing ranges. So on the hourly, this would be our dealing range. A dealing range is defined when it takes out a former low. So when this low was violated, this formed our dealing range low. And when a former high was violated, that forms our dealing range high. Okay, so this low, this high is our hourly dealing range, which is subordinate to the daily, but that's not what we're covering today. We're just going to go hourly down, but you can apply the hourly to the same premise on the daily, all right? By the hourly referencing premium ranges on the daily and discount ranges on the daily when it's moving in a bullish profile, all right? Now, let's, for example, say we're inside a daily discount and we've hit a low, so a PDA rate or a discount PDA rate on a higher time frame, and we're anticipating a higher price on the hourly and therefore the subordinate price swings on the lower time frames to tie into higher time frame section, right? What we can look for is this dealing range, and we can time our lower time frame entries with the understanding of price moving from a premium to a discount. So when price moved up into a former premium, right? So this is premium, anything below 50%, but we're in a bullish profile. We can anticipate price to pull back into a discount or fair value of the former range on the hourly before we look for continuation for price to move higher, okay, on the hourly. So one of the best things you can do, one of the best pieces of advice I can give you as a trader is, if you're an intraday trader on the lower time frame, do not go long in a higher time frame premium, because you're more likely going to see a retracement back down into a discount before price moves higher. So going long here is high risk. You can do it, but just know that it's high risk. So they're the scenarios, mate, where you might want to trade with risk off, right? Lower your risk, because price is, all it is doing is moving into a discount to offset people who were in the position long, so who are on the right side of the move, to offset them, take them out of that position, but also to accumulate more positions to move the market higher. And in order to move money in large quantities, it takes time. And so price will often move between premium and discount to allow institutions and banks to accumulate positions in quantity before they move the market higher. So that's why you'll often see periods of accumulation before distribution, especially on higher time frame, right? Because they are accumulating, they are filling their warehouses before they move the market higher to go and distribute their longs, okay? Our job as intraday traders is to get in sync with the higher time frame, to get in sync with where the banks are placing their money. So they reference the higher time frame to place their entries. So for them, fair value is 50% and discount is anywhere below 50%, and your optimum trade entry, which is the sweet spot, is between 61.8 and 72%, which is why this green box is highlighted slightly differently. Okay, so this is the sweet spot on all time frames. We can use the same principle on the lower time frame. So we know that we have this former dealing range, which took out a previous high and it's taken out a low, and price is retracing into this premium, but we're in a profile which is bullish as we've hit a higher time frame daily discount. We've seen a higher time frame break in market structure, and we're now looking for bullish price, right? So how could we use this in our favor on a lower time frame? Well, this is a lower time frame dealing range here, right? When this low violated this low and this high violated this high, this is a range. So when this low came down but didn't hit fair value, what has this left the door open to? Price returning into a discount before price moves higher. So yes, if you go back to our former episode, the previous episode, we had this break in market structure. So we're anticipating price to move higher, given that we're at a higher time frame institutional reference point being in a daily discount. Okay, we've now seen the lower time frame break of market structure, but we're now anticipating price to come back into a discount to accumulate more positions to move the market higher. All right, so again, going long here would be risky. Going long in a short-term premium, albeit you're in a higher time frame discount, you're in a short-term premium. So what you'd want to be waiting for is price to come back down into a discount to allow you to enter your position to take the market long. Okay, so this is a subordinate price swing to the parent price swing. Okay, so now price moves up, and ultimately what would you be then doing? You'd be targeting a premium of a former range. So price moving from a discount to a premium. Okay. And then once we're inside of a premium, what do we then have once we get the market structure shift that we were discussing in the previous episode? We'd be looking for price to move back down into fair value or a discount to allow the market makers to accumulate more positions to move the market higher. Okay. So what does price do here? It moves back to fair value, moves higher. But what has it done here? It's left the door open because it's come to 50%, but it hasn't gone down into a deeper discount. So at this point, you could anticipate price coming back down to this OTE zone, this optimum trade entry, to accumulate more positions. So this is where a lot of traders get caught up, because they see this break in market structure and they anticipate price to move lower, but they don't realize that the hourly is subordinate to the daily. So the daily is in a daily discount, and we have flipped bullish on the higher time frame. But price is all it is doing is moving back into a discount to allow market makers to move price higher. So we had this market structure shift at the daily discount. We've had the break of market structure. We've moved into a form of premium. Price is moving back down into a deeper discount. Yes, we've violated this low, but it didn't run down into a deeper discount. So it's left the door open in a profile which is still bullish, allowing the market makers to accumulate more positions to move the market higher. So let's touch briefly on why they would do that. And there's something called offset accumulation. So offset accumulation is really important to your understanding, and it happens on all time frames. But we're just going to use this example on the hourly, but you can find these on the lower time frame as well, because as we know, time is fractal. Offset accumulation is offsetting those who are in the position on the right side of the move. So people who went in long here are getting shaken out when price takes out this low. So it's offsetting them, and it's also accumulating their stops. So for anyone who was buying long has to sell back. So people who want to go long, i.e. banks, would buy those sell stops. So it's offset accumulation. And prices offset accumulated back down into this discount to then allow smart money, banks, to reposition longs to then move market higher, because as I said previously, they have vast quantities that they need to deploy before price finally starts to distribute into new higher time frame dealing ranges. Okay, so we're sort of segueing into the next part, which is really fundamental to our understanding, and that is buy side and sell side liquidity. So what is buy side and sell side liquidity? Well, buy side and sell side liquidity is liquidity that forms above and below old highs and old lows. So buy side liquidity is above old highs, and it's called buy side because anybody who went short here has their protective stops above the high. So if they were anticipating the price to move lower, in order to get out of this short, they would have to buy back. So anyone who accumulated here would be looking to sell their position into these stops, buy stops, because they are buying those sells. Okay, so it's a match. And then the same is true on the other side. So for anybody who went long here, has their protective stops below. So if anyone wants to run the market higher, they have to sell their position. So if anyone wants to accumulate, they need to buy. How are they going to buy in vast quantities? Well, they're going to buy all of those stops when people are getting out. So this is smart money buying below these stops. So institutions will target institutional money above and below old highs and old lows, because that's how they get to distribute their positions in such large quantities. So theoretically, or as metaphorically is probably the best way of putting it, the warehouses are being filled here. Okay, the market makers and the institutions are filling their warehouse at this point, and they are wanting to distribute their positions at wholesale, at a position where they can do that. And where can they do that aggressively? Well, they can do that where everybody or other institutions, other banks have their stops. So where they are buying back, these can sell into them buying back. And then they move the market lower to accumulate more position and induce people into believing the market is moving lower, only to then move the market higher. So what has been created here? Well, above these highs, all we've done is engineer liquidity. This is engineering liquidity, it's engineering buy stops, buy side liquidity. So when they move the market lower, allowing price to move down, the market will drop into a discount to allow them to accumulate more, only to then run the market higher again. What are they running the market through? All of these stops, buy stops. So anyone who went short here has to buy back when they get out. Anyone who's selling, perfect opportunity to sell. Right? But what has happened here is we've left the door open. We've left the door open on this discount range. Okay? Allowing price to, or market makers to induce more people into believing the market is moving lower, only to go and pick up more longs to then move the market higher. Okay? Now, this can be on a lower time frame and a higher time frame. So it's really important, depending on what time frame you trade on, to understand this, because you can use this to your benefit. So we now know that we have premium and discount higher time frame dealing ranges. We also know that we have subordinate dealing ranges and how we can utilize those to frame our entries. Okay, you don't want to be going long in a premium, you don't want to be going short in a discount, right? You know, so if we are looking at this range which was created, you wouldn't want to be going long here. You'd want to wait for price to come back down into a discount to accumulate more positions. Now you're on side with the market makers and you are entering here to then drive price higher. And what you're looking to do, you're looking to then sell into a premium and target liquidity above old highs. So if you're getting in down here, well, guess what? You know, this is where you start targeting old highs, okay? Because this is where the liquidity sat. You know, so if you're going to accumulate, you want to distribute your longs into buy stops in this example. More buy stops. What does price do? Run takes the buy stops. But when you get into a premium of a dealing range, a higher time frame dealing range, what are you anticipating? Well, you're anticipating price to then pull back into a discount, even in a profile which is bullish. Okay? If you have any comments, do feel free to drop them in the comments below and I'll do my best to get back to them as quickly as possible. But until next time, trade safe, trade smart, and I will see you on the next episode. Take care.